Welcome, everybody, and thank you for joining us today in the latest Service Department News webinar. From the video that you've just watched and from my virtual background, in fact, we've just extended the entry deadline for this year's Service Department Awards. You now have until Friday, the 5th of April, to get your entries in. So this is a great opportunity to take a look at all the categories and the criteria on the website, as we'd love to celebrate and welcome you on the 23rd of May for the glitzy ceremony. But today, however, we are going to be talking about future funding, service departments and extended stay. For those who might not know me, my name's Eloise Hanson. I'm the editor at Service Department News, and we're an online trade publication covering the global service department, apart hotel and extended stay industry. Our series sponsor for these webinars is Urban Rest, a flexible accommodation operator. We do have David on the call today, but before we meet David and the rest of our speakers, we do have a short video to play for you. And further information about Urban Rest has been popped into the chat if you would like to learn more. So a very quick overview of how today's webinar is going to pan out. We'll spend around 45 minutes in discussion today, and we'll take some time for any questions submitted by our audience members today. So if you do have any questions, please take a look at the Q&A function at the bottom of your screens. And do send these over. We like to make these sessions as interactive as possible, and I will get around to asking those questions as and where appropriate. And a gentle reminder that this webinar is being recorded, and everybody that has signed up will receive a copy of that recording within a couple of days' time. So let's meet our speakers, and why don't we kick off with David? He is first on my screen here, and he can tell you more about himself and Urban Rest. So over to you, David.
Thanks, Eloise. I feel like I have a bit of an unfair advantage now, having already had a kind of summary of the business up on screen. But yeah, look, I'm the founder and CEO of Urban Rest. We are a flexible accommodation provider, globally, effectively started in Australia, but now have locations in Australia, New Zealand, the UK, and Ireland. So really focus on tech enabling non-typical use buildings, specifically within residential boutique hotels and traditional service apartments, to enable just higher quality customer service and product, and trying to unlock them. We've a big key focus on the corporate market, particularly within that medium to extended stay segment, and hopefully continue to expand within the UK over the next several years.
Thanks, David. Over to you, Terry. Welcome.
Thank you. Yeah, glad to be here. The Altacom Group is a real estate investment company. It was founded by myself and my partner, who has 30 years hospitality experience in the extended stay and corporate housing arena. And then my background is primarily commercial real estate and capital markets, with some development, equity syndication, and some investment banking in the mix. So several years ago, I was looking for different investment opportunities to deploy capital that maybe outside of the normal investment strategies, and really kind of discovered that in the corporate housing arena and short-term furnished apartments, there's an opportunity to take a multifamily asset and generate higher returns with it by repositioning it a little bit differently, right? So we really years ago saw the kind of the investment in the service department sector to be an emerging asset class. And, you know, we've seen a lot of activity in the space, some institutional, you know, some private investors, private equity, and but really a big disconnect between capital sources and operators. And that's really, I think, where the Alticom group comes in and differentiates itself, is we're not an operator. We look to place the best operator for a given asset in a given market, try to position an asset in a given market. If we like the location, we like the sort of the bones of the asset, location, you know, the amenity package and so forth. We look to see what the demand drivers are and then try to position the asset to generate the highest return we can, bring in the right operator with the right technology and so forth to maximize the value. So we're looking to partner up with fund management companies, high net worth individuals, deploy some of our own capital. And then, like I said, you know, bring in the right operator for the right asset.
Thanks, Terry. Great to have you. And John, welcome. Over to you.
Hi, everyone. Louise, yeah, thank you very much for inviting me on today. Yeah, I'm the one seemingly sitting in the dark here. Apologies, I don't know what's happening with my camera today, but I work at HVS. We're a professional services and brokerage firm focused exclusively on hospitality, with a coverage from London across sort of EMEA. The majority of my work is spent in the UK. And I think that it's fair to say that I've certainly seen the proportion of workload devoted to service apartments increase significantly over the last sort of 15 years that I've been doing this. We advise lenders, owners, operators, all different stakeholders in connection with the development and acquisition of service apartments.
Thanks, John. And rest assured, we can still see you. So you are not in the dark over there. So before we dive into our main conversation, I always like to highlight some context slides. It really just helps to set the scene. And a recent report by Silverdor shows that globally, serviced apartment ADRs has dropped marginally, 3% between November 23 to January 24. The Americas has witnessed the biggest decline, just shy of 10%, followed by Europe around 3%, and then Asia Pacific, which is around 2%. But the appetite to invest or lend remains healthy, as you can see by the other stories on this slide. Bob W. last month completed its largest funding round at 40 million euros. And Urban Creation has also renewed its partnership with Handelsbanken for another 5 years. And on the next slide, if you've been tuning into our service department news webinars in the past, I've mentioned it before. There's a lot of activity happening up in Scotland here in the UK. And 2 screenshots on your slides here show service department buildings in Inverness and Dundee, which have recently gone up for sale. So there's clearly opportunities to buy or convert commercial assets. I know just in our speaker conversations, there's been a slight leaning towards conversions and repurposing. I'm certainly seeing a preference for conversions in this instance, which does open up the conversation to construction loans, renovation lines of credit, et cetera, which we may touch on today. And whether ESG commitments or credentials play a role in such things as valuations and appetite to lend, from what I understand, remains to really or fully materialize. You can see here that there's been efforts from operators like Beechhurst to obtain certification such as B Corp. And we will touch on the impact of ESG on investment a bit later on. So let's discuss future funding, service departments and extended stay. And I would like to kick off with the question to David, if I may. David, can you please provide a snapshot overview of general performance?
Can you elaborate a little bit on the question? When you say general performance, you mean of the market?
Let's do market, but I'm also looking at metrics, ADRs, occupancy.
Sure. So, I mean, look, us specific, we typically run kind of, well, I think the extended stay model lends itself to a higher occupancy rate naturally than the shorter term because there's less turnover and churn. We typically run it anywhere from a 85 to low 90% occupancy. And ADRs, I think it depends on the market and the asset specifically, but we've definitely seen over the past, I mean, there's always an element of seasonality. I think this has been a particularly tough winter in the UK market specifically. It has been a longer seasonal dip than you'd normally expect. The recovery didn't come through as quick as it has previously. It has now started coming back pretty strongly, I think, into March, but certainly it really extended into late Feb, which typically by late January, Feb, you would have started to see that, expect to see it recover. So I think from, you know, we obviously have conversations with a lot of people in the market. That seems to be a common theme for most operators is that the seasonal dip lasted quite longer than was expected this year. And we are definitely seeing rate pressure across the board. I think you are seeing impact of companies restructuring and still, even though the hiring starting to come back into the tech sector, which was obviously let go of a lot of people in the past 24 months, the flow-on effects and the geopolitical stuff that you mentioned previously is definitely having a squeeze on rates. So it's not significant, but I would say you're maybe kind of 5% down. But it was more the extent, I think, of the seasonal dip and the impact that has on occupancy was where it was more felt more than anywhere.
And I know you highlighted in your introduction, David, that you typically cater to the corporate traveller and the business travel segment, but where is your demand coming from?
Within business, there's a lot of, look, there's a number of industries. So our traditional type of work that we do is with kind of like project management type companies, you know, infrastructure, anyone who needs extended stay within that corporate market. There's where we're seeing a lot of increased demand has actually been in the production industry. So film, TV production, where you've got a lot of these new streaming services who are creating effectively a lot of new content. That's still very much underway and ongoing and doesn't get as affected by kind of trends within, if you're talking about like accounting firms or consulting firms who may be letting staff go. The one that's really on the uptick is within film and TV production. So we've really seen that really ramp up quite quickly. We get a lot of work from embassy travel. There's a lot of industries that sit outside of your typical kind of corporate cycles that have kind of ongoing stuff. So we've probably, I think, focused and pulled the levers a little bit more on focusing towards those over the past few months than potentially historically would have, where we had more of the, you know, kind of like the big accounting firms and legal law firms and kind of finance travel. That's the bit that's probably slowed a little bit. And, you know, kind of having to get a little bit smarter around making sure that that pipeline of demand is filling up. But we do get some retail travel as well, and that always helps to kind of fill gaps in there. So that's where we're able to maintain that occupancy level. But yeah, it's certainly I think you have to be smarter about who your target market is in the current environment for sure. And I don't know if that's going to get any easier for the next 12 months at least.
I've definitely seen varied reports on the volume of business travel, but I know from speaking with operators out there that volume is down. And I want to follow up, David, with a question. You know, is this reduction in business travel volume, how is it impacting your KPIs, and then what is your outlook, maybe not just for 2024, but you know, there's reports saying that come 2025 it will be back and will be all guns blazing. What are your thoughts?
I don't think it affects KPIs per se. I mean, our targets are what they are in terms of making sure that we're hitting certain profitability margins and occupancy levels. It kind of forces everyone to just almost work harder to achieve the same result, which is, you know, no one loves to be in that position. It's probably more of an impact in where your confidence in underwriting future deals to be like, well, actually, can you sustain the growth confidently and be sure that they will actually, new assets will perform to the same level of, like, stabilized assets are generally easier to operate anyway. As you're bringing new assets into a market and trying to bring new clients in and convince them to come and stay somewhere that they don't know. Like, there's always a bit of a ramp up period anyway, but getting people in to see a new asset is one of the bigger challenges before they actually start to book it. And I think if you see a slowdown in travel, that becomes harder and harder because they've already got, you know, kind of preferred suppliers that they'll just stick with, and they're probably getting more price competitive anyway. So I think more where you see the impact is in the underwriting of future deals and what that cadence and velocity looks like in terms of, you know, if you'd asked us 12 months ago, we were picking up as many new assets as we could because the market was, you know, going gangbusters as you were still getting that COVID tailwind. Whereas I think there's a bit more caution now in the market around just needing to be either much more confident in the location or having a bit more of a buffer in there when you're looking at your kind of underwriting, how you're thinking about it. So yeah, that's kind of the bigger impact I think that we're seeing on it.
Mm-hmm. A comment from Richard Majewski in the chat here. Hi, Richard. On the topic of demand here, he said, seems to me both white collar corporate and also blue collar contractor have been on their knees January and Feb, and are both coming back in March. So the outlook looks like it's on the up.
Yeah, that I think we've definitely seen that trend as well, to be fair.
Yeah, nice one. Terry, how is the economic environment impacting your investment strategy?
Yeah, interesting question. I mean, you know, the economic environment, you know, we see kind of a global slowdown. I don't know that I mentioned in my original introduction, but we're a U.S. based company and we're focused on U.S. real estate. So, you know, we're looking at you know, the economy from that perspective. And in the U.S., you know, we do see a highly inflationary environment, which is going to keep interest rates higher. We believe, and really a general economic slowdown. So against that backdrop, there are a variety of effects that it's having on our investment business activities and our strategy going forward. But on the positive side, I think what we're seeing is that, you know, really the raw material for our investment business is the hard asset, you know, the real estate, the multifamily properties. So with the slowdown, with higher interest rates, we're seeing very, very significant discounts on these assets versus where they were trading maybe a year or two or three ago. We're seeing a very precipitous slowdown in the process of selling an asset, right? I mean, typically you'll see properties come on the market. In the past, the due diligence periods were very short. We're competing with large institutions for these assets who would have maybe a 15-day or 30-day due diligence period, probably put up hard money day one, and close in 15 or 30 days after that. So, you know, at least they would promise. They didn't always deliver, but, you know, they would promise to do that because they're institutions, they had a high degree of credibility. So it was very difficult for us to compete against those kinds of buyers for those assets. And in this environment, it's completely different now. We have brokers calling us back. We have developers calling us. I mean, they're coming to us now with deals. Or we see deals that maybe were marketed a year ago or even 2 years ago that didn't trade, where the prices come down, you know, 20, 30, 40% from where it was expected to trade previously. So we really like this environment from an acquisition strategy perspective. Certainly a lot of opportunities that we're looking at now in the office conversion arena. These are properties that, you know, our focus is primarily urban markets with high walkability, safety, very active street environments, and you'll find a lot of office properties in those types of locations that just don't work anymore. And we're seeing some high quality, what maybe previously would be considered high quality properties in high quality urban locations, trading at $100 a square foot or even less than that. So I would say that with respect to how the economy is affecting us, I mean, certainly high interest rates are affecting everybody, but we think that we're able to achieve returns on these assets at these discounted prices that will allow us to not only cover debt service, but cash flow in the high single digit to low double digit arena, which was previously unheard of. So we like this environment, and again, against a backdrop of growing demand, right? I mean, we're all seeing this extended stay arena bringing in all different kinds of players on the technology side, on the, there's been many billions. I think at one time we counted $10 billion worth of sort of venture capital investment, and that was a year ago where we did that. But investments into operators, into technology, and startup companies. So I think we're just seeing an emergence of a new asset class, and it's the very early stages right now, we think. But we also believe that there's going to be cap rate compression in the future, which is going to make these assets more valuable, even if income levels stay the same. So we're excited about it.
You mentioned a moment ago, Terry, that there was a 20, 30, maybe 40% reduction in price, but correct me if I'm wrong, that was on the sort of multifamily side.
Yeah, that's on the multifamily side. It's not really across the board. It's just specific assets that we've maybe seen marketed previously. We've seen assets trade. There was an asset in California that had previously traded for about $160 million that went back on the market and didn't see bids that were able to cover their debt, which was around $100 million. So that's those are, I mean, you've seen markets maybe that were previously 3.5% cap rates, where those same markets now are, maybe 5% cap rates. So, without the rosy prospects for, high growth in revenue, right? Everybody's underwriting now to, really negative, either flat or negative growth in rent. So you're not getting the benefit of that either on the underwriting side if you have a multifamily asset. We're seeing developers who are coming out of the ground now and getting ready to move into the lease up phase and are looking for alternative strategies because, when they got the loan, maybe they were at 3.5 or 4.5% interest, and now they're, as floating rate mortgages, they might be at, 7, 8, 9% interest rates. So they're, and then they also have a slowdown in lease up, and they're wondering how they're going to get out of the assets. So we've gotten calls from a few developers asking us to take a look at their assets to determine whether or not it could be repositioned to generate more income as a service department. And so so like I said, we like this environment a lot more than we did a few years back.
To revisit the topic of interest rates, and Terry, you mentioned that there has been a slowdown. How far do they need to come down before lenders and investors really start to take the brakes off and ramping up activity? And do you have a ballpark timeline as to when you think that might happen?
Yeah, I mean, our perspective, our crystal ball probably isn't any better than anybody else's, and I've been in the investment business a long time to know that it's really extremely difficult to predict interest rates. And so with that in mind, our outlook is that, there's a tremendous amount of debt, government debt that's been deployed. We see that trend continuing. We see that, we don't think that that it's worked its way through, that inflation is going to continue. We're in election year, so maybe there'll be a little bit of a softening, but then 2025, we think interest rates are going to continue to be relatively high. We don't see them coming down anytime in the near future, but at the same time, I think with the price adjustment on the hard asset, that's going to make up a lot, right? So if we, we're looking at returns into 9, 10, 11% unlevered, right? So if that's against a backdrop of say 9% cost of debt on a bridge loan, we're still in the positive category. We have positive leverage in this sector, which probably none of the other real estate asset classes, can say that right now. Everybody's in sort of negative leverage territory. Mm-hmm. So that's what makes this asset class very, very appealing. But there's some things that make it very difficult also from an investment perspective. And that's primarily the lack of data, the lack of transparency, and just an inability really to put institutional type underwriting to the test. We find ourselves spending a lot of time trying to find data. I mean, even if you ask somebody what's the cap rate, expectation, the exit cap rate on a service department. I mean, I think you probably have a lot more data in the European arena than we do here in the U.S. But I think that gap is going to be closing. And at the same time, it's an opportunity, right? If we can figure it out, we have an opportunity to you can use inside information in the real estate world, right? So just having good connections with good people, with good operators, with information providers like HVS, collaborating, if we can put good data together, we can attract the capital because the demand is there and the price for the assets is lower than it has been in the past.
We held an event, an in-person event last week in London at the Reform Club. It was all around financing and refinancing. And Andrew Harrington of AHV Associates gave a short presentation on his long-term interest rate prediction. So over the next 5 years, up until 2029. And his slide showed a very slow decline over the next 5 years, but not getting below around 3.5%. So little change, but no way near back to the historically low levels that we have seen in recent years. And on the topic of data, let's bring John into the conversation here. Are you able to provide us with an overview of some key transactions within the service department and extended stay sector?
Yeah, absolutely. I think almost in a way it's sort of worth starting, sort of flipping that question on its head, in terms of what haven't we seen before we sort of drill down into the transactions that we have. I think what has been absent, certainly from the sort of European arena in recent months, is large sort of platform sales. And I mean sort of platform sales of properties rather than sort of operational structures. And I think that's what's really sort of lacking. And that mirrors in a way what we've seen in the sort of wider sort of hotel investment arena as well. But in terms of sort of significant portfolio trades, that is still very much absent, I think. And I hope we see more of that, this year, and I think that we will. But if you look at sort of larger portfolio trades from the last sort of 12 months or so, there was a portfolio in France, Capital Land's disposal of 4 mature service department buildings in France earlier in the years, and that was one of the sort of larger deals, which is around the sort of 40 million euro mark, which is a sort of price per bed of around sort of 130, and reflected a sort of going in yield at around 4%. But mainly, the transactions that we've seen have been of single assets. And most of them, or a majority of them, have reflected sort of value add opportunities. Again, I think what's sort of missing from the market is that sort of institutional piece, in the way that it was, pre the significant rise in interest rates. Those very low yielding fixed lease investments aren't, that have clearly sort of moved out in terms of pricing. So most of the asset trades that we're seeing in the arena are of sort of direct sort of income cap of operational assets. But a couple that sort of caught my eye from the last sort of 12 months or so, Jastar's acquisition of Native Bankside, sort of going back sort of 12 months or so, but it was I thought that was quite an interesting transaction, that sold 75 units for £40 million last year. And what the owners did upon completion was that was a fixed lease investment, but they actually, in agreement with the operator, re-geared that arrangement to a management contract. And I think that that is quite indicative of the wider what we're seeing from investors more broadly in terms of a desire to access sort of direct sort of income rather than that sort of more traditional fixed lease arrangement. And then another one that again caught my eye again in London was Stay City's acquisition of a site in Stratford. So that was an operator taking planning risks on a site which previously had been consented for sui generis, and then looking to gain consent for C1 use and then build the site out themselves in a JV structure, recognising again the movement on sort of fixed lease investments. And again, I think that's quite indicative of an operator or operators being innovative in terms of looking to try and create deals.
Hey, John, do you mind if I ask you a question? Sorry, Eloise, to take your job. I just want a follow-up question there to John. Where you were saying you're seeing the restructure of a fixed lease to a management contract. So we offer both effectively. We're seeing probably some of those challenges in the funding costs now are higher than typically the yield you're going to get from a fixed lease, where obviously you can get significantly higher returns as an asset owner under an operating structure. But from a funding perspective, and maybe this is post deal, it's easier to organize. Actually, because of the risk that's attached to the operating income. So just curious to get your insight as to the thought process or kind of motivations behind that switch. Is it just to achieve it, and then does that impact kind of pre-funding stages, or can that only happen post the debt being raised for in terms of taking on the more risk kind of contract that's attached to the operating structure?
Yeah, it's a really interesting one, isn't it? I think from an operator's perspective, we're seeing more versatility in the nature of agreements with operators. From a funding perspective, lenders are, from my experience, that they are concerned about profile of income, clearly, and if you have a covenant from a strong tenant, then that may well sort of offer sort of preferential sort of lending rates. But I think that back to the point discussed earlier in terms of benchmarking, I think that if there is sufficient grounding in a business plan that has been prepared in terms of reliance on third-party data or third-party reports, then if there is sufficient sort of proof of business plan and proof of concept, then I think there is still sort of sufficient demand from lenders out there to explore sort of operational platforms. But yeah, I absolutely recognise there is a difference in the nature, the way that lenders would approach the two sort of various sort of income appraisals. I suppose how I'm looking at it is more from an investor perspective. And as I say, I think there is more demand from investors to obtain sort of higher yielding opportunities with access to sort of direct sort of cash flow. Potentially through sliver equity with an operator, or through a sort of hybrid arrangement. But I think we've certainly seen that change over the last few years in terms of the willingness of operators to explore more sort of hybrid arrangements.
John, could you elaborate further on lenders in terms of their criteria, requirements, general sentiment towards the sector? Are they optimistic? Are they cautious? And typically, how are they looking at risk in and amongst that?
I think that for most lenders that I speak to, service apartments fall within the sort of living sector and are viewed within that sort of framework. And generally, there has been a significant shift in appetite for those sort of living sectors. I don't think that serviced apartments you know, but by themselves are sort of viewed uniquely. I think the attractions of the sector are fully recognised in terms of the relative lack of food and beverage facilities, which have clearly increased in cost significantly in recent months. And the sort of operational efficiencies that are associated with them. So I think broadly as an asset class, they're viewed very favourably. I think going back to that point on benchmarking, what is difficult is to try and benchmark against third-party data. And I think that it's interesting hearing you say, Terry, in terms of the relativity in the sort of European markets to US markets. But I think there's a lot of work that still could be done to improve that sort of more market-wide benchmarking data for the sector more broadly.
Yeah, I mean, I'll jump in here too, because we've financed the acquisition of a multifamily property that we're converting to a hotel, and so we have direct experience, recent experience, and we're in the market now also for another large apartment building that we would be looking to convert to serviced apartments. And we're getting a lot of feedback from the different lender types in the market. And I would say that in our experience in the US, which may be different in the UK and other, European and other world markets, it's not really a recognized asset class, right? Is it a multifamily property? Is it a hotel? Is it something in between? I mean, there's more liquidity for multifamily. So to the extent that it looks and feels like a multifamily asset, there's a higher comfort level there. We've seen lenders typically get comfort by underwriting the assets as multifamily. So meaning using the sizing parameters that they would typically use for a multifamily asset, whether it's debt service coverage ratio or debt yield, loan to values and so forth, with the idea that, oh, if it doesn't work as a hybrid asset, a serviced apartment, or whatever it is, then it's always multifamily, and we understand that, right? So that's kind of the fallback position, and fortunately, these assets will underwrite. I think if someone is looking to stretch the leverage on these kinds of assets, it's probably not going to work out too well. But for conservative leverage, where the asset underwrites as multifamily, to give the lender comfort, typically will provide sufficient proceeds for us to generate high yields on the equity side. So and that's going to, you've got bridge lenders who have an appetite for high quality assets in strong markets, but don't necessarily require in-place cash flow. And they're a little bit more flexible as to how they'll view the potential income stream. On the fixed rate side, I think it's a bit more problematic. I think you have banks that are largely out of the market right now. There are a few still players, but those are very banks are typically very locally focused and relationship focused. So it's not a good strategy for us when we're looking at deals all over the U.S. I think you've got life companies that are very, very conservative and low leverage. It's generally not a good fit for them, but we do have some life companies looking at the assets that we're looking to finance. I think on the CMBS side, there's an appetite there. There's a curiosity there. They've played in this. Some of them have played in that space before. And we think on the takeout side for a bridge loan, we think that CMBS is a viable exit strategy on the debt side in the future, but that's a volatile market and depends on where they are any given day or any given year. But I think probably the most reliable source of capital right now for us is the debt funds on a bridge loan basis, and then we'll look to the future. Hopefully there'll be more permanent lenders when we look to exit some of these assets in 2 or 3 or 4 years.
We focused on multifamily opportunities during this conversation. We've only lightly touched on offices, which is something that I'm seeing more I'm typically covering more stories of office conversions than I am multifamily. And David, I'm curious to hear what you look for in a potential property, and with that in mind, what's your preferred route for splitting the bedroom types in terms of your mix between studios up to 3 beds?
Look, if you're talking about like office conversions specifically, look, they're hard to make work, right? And I don't think you really have the flexibility that you have in traditional when it's been purpose built for something else. Where, particularly if it's purpose built for service apartments, you're going to have a much higher skew towards a smaller footprint of one bedroom, even studio type products on the larger size. And then that kind of declines as you go up the bedroom count. So you'd be typically looking at 70 to 80% in a kind of studio one bed mix, and then the balance coming in twos, maybe a couple of threes, because that's where the demand sits in that market. If you're talking about office conversions, you're very much kind of defined by what the existing floor plate is and the layout. They're really hard to make work. I think where they do work, there's great opportunities because, there's been so much impact of interest rates in the commercial property sector where you've seen, when you're talking about those 30-40% price declines in a very short period of time, that's where you're seeing most of that is in B and C grade office, particularly in fringe markets where it's not core, and a lot of the time they might sit empty for a year or more, earning no income. So conversion into service apartments is easier than conversion to resi. Whether or not they stack up, there's not that many assets that do based on the floor plate and where the core position and the services are run through the building. When they do work, they're really attractive as an asset class, but it's just hard to make it work. And then when it is, you're kind of defined even by the depth of the building to see what size units and can you put in there. So we would generally work in something like that. You want it as compact a size as possible. The ideal is, you convert them to studios or one beds, but given the fact that it may be a deep floor plate, in order to get natural light, you may end up going into a larger part. But the other challenge that we've seen in conversions has been the ESG rating of older buildings, and a lot of the times you almost need to strip them back all the way to the core in order to rebuild the facade to get them up to a reasonable level when you're thinking about the resale value. So I think it also depends on who the buyer is. Is it an existing asset owner, or is it a buyer who's going to retain that for the long term? Will be different as opposed to somebody who's coming in, like where Terry might be looking at some of these things where they're looking to exit them within kind of 3-4 years. And you need to be thinking about what the ESG rating is around that building. It's quite difficult on an existing office that might be 20-30 years old to actually get that up to a level that will transact quite easily. So sometimes the income stream won't necessarily offset the challenges that you'll get from the conversion or the impact of the kind of valuation down the line from that. So yeah, look, they're tricky. When they do work, they're great. And there's some really interesting kind of some of the older, more industrial style offices where, we're looking at one actually in London at the moment in Hackney, where it's an old wool store which is being converted. They're going to extend it and add it on, but I mean it's not a cheap conversion either. It'll be an amazing kind of big New York style windows when it's done, but that's kind of they're harder to find, I think, than like the traditional office. What people think about to get them to work is just challenging with the floor plate. But yeah, ideally you want them not as small as possible. For the extended stay market, you still, I mean, if you're thinking in square meters, probably 40 plus square meters to actually make it comfortable to live in. And that way you're getting optimize the yield really from the floor plates by putting in as many as possible.
I've heard from other operators that there is a general trend to shrink or reduce the size of rooms, whether that is being mirrored elsewhere in a general movement between room size and ROI.
ROI is a big thing. I would say that is so design driven in terms of like how well is the space being used. Like you can have a 55 square meter one bedroom that is a terrible use of space, which feels cramped and small and is not particularly livable. And you can have somewhere that's almost half the size that actually has a much better use of space when they've been well designed and thought out, from everything from storage to layouts to flow of units. So there's a real trade-off there in terms of, you can't just, there's no easy rule of thumb. I think you can, if it is well designed and you have this, where it's easier to work from scratch, right? If you're designing this and go through the DA, you can get very optimally designed small spaces, which are great from an ROI perspective. If you're using an existing core or structure you need to fit within, it gets much trickier to do that. But yeah, I mean, I would agree. I think generally more people want to be kind of out and about. You see more common areas where there's co-working spaces for kind of, it's places people don't necessarily want to be stuck inside the whole time. So a small bit of balcony or outdoor space, and then some common areas where people can go to like work and stuff. I think, and that's kind of where you could see that convergence with the co-living model and all these kind of, hospitality verging with real estate and the blend of those and into co-living. And people effectively want value for money, I think, is the big thing. And if you can get that through reducing rates by having smaller floor plates and getting the same ROI, I think that's why you're seeing a lot of that trend. That's where, in a cost of living crisis, that's where the largest demand profile is, in the, accessible price.
There's two topics that I want to cover before we reach 3 o'clock. So we are fast approaching our allotted hour. One is ESG and one is refinancing. We've just lightly talked about ESG, so I'm going to stick with that one for now. And I can see we've got a question, another question from Richard on ESG, but generally speaking, Terry and John, I'd be interested to hear your thoughts on this. What impact do you think ESG will have on acquisitions, lending, investment strategies, etc.? What are your thoughts?
Well, from my perspective, we're focused on finding buildings in markets that we can deliver great customer experience and a solid return to our investors. To the extent that ESG comes into play, whether it's attracting debt or equity capital, is not really a factor for us. It's hard to overlay too many parameters to get everything to line up, and so it's not even on our radar. Mm-hmm. I think from an operating efficiency standpoint, that's all great, but if you've got a lower expenses as a result from that, that's going to appear in pricing anyway, right? So it's going to be priced into the asset. In terms of attracting capital, I think it's a factor, but it's not a driving factor. So, there may be deployers of capital who are looking specifically for those types of assets, but are they looking for a service department, in DC that's, 75 units? I don't know. It's just not something that we focus on.
John, is this in any way, factoring into your conversations?
Yeah, it's so funny, isn't it? There's so much there is so much sort of discussion around ESG, but in terms of the sort of cold hard sort of tangibles of how is it impacting pricing? Funnily enough, I had an example in the last few weeks whereby we're working on a transaction, and as part of the transaction, the pre-acquisition building survey that was prepared identified works required in order, this is a building in the UK, identified works required to bring that property into line with MES 2030 regulations, so to achieve an EPC of B or higher, and they amounted to about 700k, and that was firstly reflected by the buyer in terms of their pricing, and secondly reflected in our valuation as part of it. And that's the first time I've seen such a tangible example of these regulations which are still, I think, in their interim stage. But really, the cold hard impact of of sort of ESG in terms of values, I thought that was quite an interesting example. And secondly, again, we are starting to see these whether or not they're green premiums or a sort of discount for more sort of dilapidated buildings, but certainly in terms of we have worked with a sort of pan-European credit fund who are providing pricing incentives for ESG targets. So, and I think that is again a sort of tangible example of where we're starting to sort of see this more sort of flow through more freely. I think from the sort of G perspective, I think there is talk as well from some institutional investors in terms of the investment vehicles being used in the UK and European arena, in terms of the transfer of companies rather than pure asset property deals. So yeah, I think that's potentially one to watch as well going forward.
Question from Richard, which I'll direct to yourself, John. If we can argue that serviced apartments are more attractive in terms of ESG than hotels, does it mean that they're more attractive for investment?
I don't know if there's any correlation that I've seen to say that they are. I don't think, as sort of Terry was saying, that will be a driving factor. This will be building specific and market specific. But I think that there is clear opportunity to and clear appetite from investors to make sure that buildings will comply. The thing that is going to drive this is going to be legislation as and when that comes through. But I don't think that in of itself that serviced apartments have any sort of distinct sort of advantage over hotels from that perspective.
Mm-hmm. The second topic that I wanted to cover is refinancing. And a quick stat here. AEW is forecasting a default rate 7.5% across loans originated between 2018 and 2021, which could lead to 14.5 billion euros of losses for lenders. John, is this of a concern to yourself around projecting levels of refinancing? Do you think we're going to see flexibility from lenders on these maturing loans? And do you have any advice?
I think we're already seeing it, right? And I think lenders have been flexible in the main across hospitality to reflect what has happened over the last few years. I think what is encouraging is how diverse that lending landscape is now. It's as diverse as I've ever seen it in terms of the mix of debt funds, high net worths, operating in the space. The days where the market was completely monopolized by the high street lenders is long gone now. So I think there are more diverse pools of capital. It all comes down to how sustainable are those debt levels, doesn't it? And I think that when debt was obtained of higher EBITDAs and higher NOIs, then there is an issue to be resolved, isn't there? But I think there is, if the expectation, if you step back, looking from people have been talking about this now for a good 2-3 years about this sort of impending sort of wall of debt that's coming up for maturity, and we haven't seen that reflected in the levels of distress. We have seen instances of distress, but especially in the serviced apartment arena, they've been pretty minimal. So I think we're going to see more distress going forward, but I don't think it's going to be a long way from being an avalanche.
Mm-hmm. I have a final question that I would like to ask all of you before I run through some closing slides. And my question is, are you more or less optimistic about the future than compared to a couple of years ago. Terry, let's kick off with you. What do you think?
Well, personally, as an investment firm, I think you have to be optimistic because there are always opportunities, and especially in periods of disruption in the market like we've seen today. So I think having solid market knowledge, having access to information, having strong partners, good deal flow, good access to capital, an emerging asset class, all make for a real exciting opportunity for the future. I think, as I said before, the market disruption, a lot of players, a lot of investment groups, a lot of capitals on the sidelines right now, and with an opportunity to take a hard asset and create something new and exciting that generates more income. This is kind of a perfect storm for us.
Mm-hmm. David, what do you think? More or less optimistic?
I mean, as an operator who went through COVID, I guess it depends on how far back we're looking as to where my optimism levels are based from. But I would say, in terms of opportunities, I would say I'm more optimistic. I think anytime there is any sort of disruption within a market, you see a lot of opportunities and great deals to be done. We've seen, quite a few where they have been cross-collateralized or distressed, where asset owners have been able to work with them to pick up great deals, and we kind of get a great deal alongside them. I think, specifically to our environment, I think the operating environment will be challenging in the near term, but long term, we do like to consider ourselves at, relatively at the forefront of this convergence of asset classes where you're using technology to enable kind of, multifamily or it just improve the pure play service apartment customer experience, and you can actually convert multifamily or built to rent to make it actually suitable for corporate travel. So we're very optimistic for the long term for sure. It will be a challenging couple of months, I think, in an operating environment, but overall, we think the trends that are emerging from this, lends well to us and just ends up creating a better product for all of our customers in the market as well.
Mm-hmm. 2 out of 3 optimistic. John, what do you think?
Very, very pessimistic. There's got to be a pessimistic. No, Imogen, I think everything is in place for the to be huge growth in this sector now. I think that the model is proven. I think we've seen huge innovation from a wide variety of operators, as David was saying. And we're starting to bring that sort of brand loyalty is starting to build across the sector. And I think with more sort of consolidation and hopefully build cost inflation coming down now, which I think it certainly is. I think, as I say, that the sort of building blocks for sort of the future evolution of the sector is really there. I think it has a solid grounding for future growth in new markets outside of the more sort of traditional ones that are already sort of well established here in Europe. I think we will see further diversification from groups into other markets in Europe, certainly going forward.
Brilliant. That's a home run for us. 3 out of 3 optimistic. So what a great note to end this webinar on. Whilst my colleagues pull up some closing slides, I'll take this time to thank our speakers, Terry, David, and John. And I'll also mention that we'll keep this webinar open at the end for an extra 2 minutes, just so that our audience members can follow up on any of the links that we have popped into the chat. The most recent link that we've popped into the chat, our next webinar, taking place on the 25th of April at 2 p.m. BST, hosted by my colleague George Sell. Should the extended stay sector be wary of Airbnb? We'd love to see you there, and the link to register has been popped into the chat. And if you were here right from the very beginning, you would have seen our promo video for the Service Department Awards. Tickets to the ceremony are on sale. We sold out for 2023. So guarantee your seats, book early, and come and buy your tickets. Would love to celebrate with you. And our shortlists for the awards will be revealed towards the end of April. So we look forward to seeing you there. And if you're interested in working with us, either across our webinars or our in-person events like the Service Department Awards, please get in touch with my colleague Rav. Her details are on your screen and also popped into the chat. Big shout out to Urban Rest, particularly as we have David on the call today for being our webinar series sponsor. But I will also thank Terry and John for their insights. You can connect with our speakers with their LinkedIn profiles all into the chat, or you can connect with us at Service Department News on any of the social media channels that you will shortly find on your screens. So take care of yourselves, enjoy the rest of your days or evenings, depending on where you are. And we look forward to seeing you on the 25th of April. Bye now, take care.